Hello and welcome to Securities Lending Saturday. I'm Roy Zimmerhansl and I'm your host. Today, I'm going to be talking about the industry financial results in 2021 and the outlook for 2022. So, if you're interested in securities lending, whether you're part of the ecosystem, if you're a lender, a borrower, an end user on the lending or borrowing side, or if you're just plain interested, then this is a place for you. So, let's get started. Hello, everyone. It's me again. It's Roy Zimmerhansl, and I think we're all good to go. Fanny, great to see you. It's always a pleasure to see that you are in the audience. I appreciate you making the comments. As I said, today I'm going to be talking about a brief reflection on the industry financial results. And I don't know how long this show will go, so we'll see. A lot of that last week came from some fantastic questions from people in the audience. So that was great. It's been a hectic week. I don't know what your week has been like. Mine's been filled with ups and downs and quite a lot of grind. We made it through. It's Saturday. The sun's shining. And I have to tell you, I am looking forward to a great weekend, as I hope you are as well. As regular viewers will know that I always have a slide deck. Very quickly, as I said, we're going to be talking about sort of reviewing revenues this week. Next week, we're going to take a look at CSDR and securities lending, what the potential impact of that might be, and what my expectations are, or maybe some differing views from other people that want to share them with me. So really always happy to get feedback on that. This is what we have been talking about in the previous 34 weeks. So we're getting closer to that 1 year anniversary. And thank you very much for being with me on this. This is what we're going to talk about today. Now, this topic was actually inspired by a LinkedIn blog post from Boaz Yari, who's the CEO of ShareGain, where he was reflecting after the end of the first month, or not even quite the end of the first month at that stage, where we'd seen falling prices and reduced revenues in some examples. And he highlighted Interactive Brokers and Robinhood. So I'll be reflecting that, and also mentions market volatility and trading activity. And as a final point, he mentions payment for order flow, which we won't be talking about, but obviously is a big revenue generator for many of the online brokers. So we're going to look at the reviews or the revenues, and we'll talk about some good news, some bad news. I'm also going to give you my thoughts on what usually happens with securities lending revenues and how you can give yourself a little bit of a broad guideline in terms of how revenues are likely to come out based on the little matrix I'll show you. And then I'll give you my own thoughts on the outlook, the positives and the negatives, and give you a suggestion as to where I think the business might go. So as always, these sessions are, the first 10 minutes are going to be left on LinkedIn. The full session will be edited down. So after the live session, which will be available in its entirety, we'll cut that back to the first 10 minutes. I'll do some editing over today and tomorrow. And the live or the recorded edited version will actually be available on YouTube, on our YouTube channel tomorrow, Sunday at 3 p.m. I'll give you the link. That's the link for our YouTube channel. We have in excess of 100 videos up there now. I think this is a pretty comprehensive package. There's just about everything you want to know about securities lending you can find a video on. And if not, then drop me a line and tell me what it is that's missing as far as you're concerned, and I'll do my best to put something up. Again, CSDR was a suggestion from another viewer, so always happy to take that. In fact, the last several have been user-driven. So that's good news, and I really appreciate that. Okay. As always, if this video or the other videos have been helpful, it'd be great if you could give us a thumbs up or a like or whatever the equivalent is on the platform that you're watching, whether you're watching live or whether you're watching on replay. We always appreciate that, so I know which videos capture your interest and which ones you might want to see more of. That's always useful and helpful to me. Remember, you can sign up, as Fanny has for some time, in terms of being a regular subscriber to the slide decks that come from the series. So sign up there, and then over the coming days, you'll actually get not only this week's episode sent to you, but also previous weeks. So if you're interested, just go there and sign up. Okay, now everyone that's been watching for a little while knows that my real goal at the moment, my short-term goal, is to get to 500. We've had another great week. We've added another 20, I think, this past week. So we're over 450 subscribers at the moment. So that's great news. When we get to 500, then YouTube will open up the community channel. And what that means is there'd be more opportunity for interactive questions and answers. You don't always have to wait then for the next video. So if you're interested in learning more about securities lending and you're already a subscriber, thank you very much. But also, please share that with your friends, colleagues, and contacts to see whether they're interested in learning more as well. Help me get to that 500 number. We open up the community channel, and I'll also be doing a giveaway. When we got to 200, I did a few giveaways on courses, and I'll do the same again when we get to 500, in addition to the community channel. If this all helps, please subscribe. Okay, let's talk about the good news. And look, there's lots of good news. If you look at one of the headline stories, Equilend, the automated trading platform, 2021 had their highest annual trading volumes. Okay, so let's unpack that a little bit. So first of all, the numbers are up. That's great. That means that there's more trading going on that's captured within that platform. Now, of course, not every trade happens within Equilend. And so the question you need to ask yourself, is that because maybe there's more firms that were trading previously that have come onto the platform? Are there new users? Are existing users using it more in more situations, more applications? Or is this just genuine industry growth? So I think that's a great question, or three questions. And we'll find out as we unpack the data. As more information comes out, we'll be able to put together a bigger picture of what's happening across the industry. Remember, one statistic on its own is almost useless. It's okay to identify a snapshot, but that isn't in and of itself meaningful. But if we look at some of the market participants, we look at State Street, they reported that their fourth quarter 2021 securities finance revenues were up 16% year over year. So look, that's great news. The interesting thing is, if you go back to the end of 2020 for that comparison quarter, remember some of the markets still were in short selling bands. And so you would expect Q4 to be bigger, Q4 2021 to be bigger than Q4 2020. One of the interesting anomalies, though, is that many of those markets that were still in short selling bands were Asian, in particular Korea. If you look at some of the data that Equilend was talking about and disclosed in terms of their trading volumes, there was double-digit trading volume growth in every region in 2021, except for Asia, which was only, I think they said 7%. So it's quite interesting to see that revenues can be up, trading volumes can be up, but it's not necessarily automatic that revenues and volumes tie. If you look at BlackRock, their fourth quarter 2021 lending revenue was also up, I think a little bit under 4%. So that's positive news as well. And one of the comments from Interactive Brokers said that their strong fourth quarter results were driven partly by securities lending activity. So again, what we see is a wider connection of the business across a wider community that really reaches retail investors as well as their institutional clients. So securities lending, many positive comments there from a revenue point of view. Of course, there's also bad news, because interestingly, on the one hand, Equilend reporting trading volumes up, but DataLend, the sister entity that does the data analytics, looking at January 2022 revenues, comparing it to January 2021, and actually seeing revenues drop by 12%. Similarly, over the course of the full year 2020, BlackRock's revenues went down 15%. And the comments, which were part of a horrific set of numbers from Robinhood in their fourth quarter earnings, again, the decrease was partly due to lower interest return from users from securities. So again, securities lending being mentioned time and again. And if you look at January's performance, Interactive Brokers, their margin loan activity was down in January compared to December. So not the best trends to start 2022. Okay. Heading in the wrong direction. And of course, on top of that, what you also see is to the extent that you have asset values dropping, you find that obviously if you only had one loan outstanding, it was outstanding in December and it was outstanding in January, and it was for the same fee, but the stock market dropped by 5%, you're obviously making less money, even though your activity hasn't changed. So to the extent that we've seen some falling markets this year, that's a problem. And the one of the background charts, this one is the MSCI World Interactive. You can actually see that it's down a few percent. You can't see that, but I can tell you that it's actually down a few percent since the start of the year. Trending in the wrong direction, of course. It did recover, and over the last few days has been getting a little bit better, but the trend at the moment is downwards. So that's bad news. Not great for revenues. And we'll see how it goes. That's something to keep an eye on. Now, I wanted to actually include this chart today because I was trying to show you that historically, this kind of a matrix approach is pretty good for predicting what's going to be happening to revenues. So on the one hand, what you actually look for is two axes here: prices when prices are rising, stock market prices, or the values of the securities that are actually on loan, and the other is volatility as it rises, heading off to the right. So the worst market conditions you can have is where there's very little volatility, and either the stock market is just ticking over and staying very flat, or there's falling prices. All right, that's about as bad as it can get because there's no real incentive for new activity. Because if there's no volatility, how is a short seller going to make any money from that point of view? And the perspective is just negative. Now, if you also have very little trading activity and very little volatility, and the stock market prices are actually trending downwards, of course, that's pretty bad as well, because as asset values drop, the money you're making from your existing outstanding loans also drops. And if there's no volatility where people have the opportunity to get in, put new trades on, close out other trades at a profit, it's a relentless grind. So I'm now going to put you on mute for a second while I have a Coke, because although I'm still not sponsored by Coca-Cola, I still love my Coke Zero. Okay, the voice has had a bit of a workout this week. I've had a few reasons to shout out loud in happiness generally. So the worst scenario is low volatility with flat or falling prices. Then next is low volatility with rising prices, because again, opportunistically, there are fewer trades for people to actually capture revenues. But that's where you see often lending outstanding values rising pretty consistently. So if you have a steady uptick over the market, like we saw really from, I guess, 2009 until, really for most of the last 12 years, in that kind of an environment, you just balances go up and up. But what ends up shifting often is the higher the market goes, the less likely there is to be specials because there's no volatility. It's only just going up. But what is more loans being put on the books that are actually hedging positions. So that's either in main indices themselves or in big names. So you might see people using some of the FANG stocks as a proxy for the overall market, since they're so impactful in most indices. You can get sort of proxy coverage without having to replicate the index. So you see more what we would call general collateral blue chip stocks being on loan because they're just general hedges rather than opportunistic trades. Okay, so low volatility and rising prices, you can still make some money on it, but your return per unit of risk is going to be lower because you're putting on more GC and there's fewer specials. The next best, or the second best quartile here, is where you have high volatility and falling prices. So the reason that's good is because that's really where you get momentum trading. If you have falling prices, but the market's quite erratic and it's going up some days, going down some days, going down big some days. We've seen some of that this calendar year. That's a good opportunity to make money, right? Because there's more trades going on and off. There's more opportunities to actually try to grab big names and grab some big specials. The problem with this sector is that once the stocks have fallen, the positions get closed out at some point, people book profits, and then you're at a lower market plateau, and the continuation of it might be difficult. So you might have a good month. You might have a good month because it's quite volatile and you have falling prices. But then once things stabilize again, and they always do, the reality is that there's fewer opportunities, and the asset values that you've had on the books all the way along, they're just paying you lower returns because the mark to market valuations have dropped. So it's good sporadic, even though people think that this is when securities lenders make all their money, they make good money while it's happening, but afterwards it's a bit of a damp squib. And of course, the best market is where you have lots of volatility, but markets are going up. So they're going, you have some down days, but then you get a big rise and then another down day, and then you end up higher, and you want to keep going like that. That's where the biggest opportunities are. That's where the most lending revenues are. And that's really the best market conditions. So if you apply this matrix, it's not a guarantee, and you can't really do it at any given snapshot point. You have to look at what's happening over a week, a month, a quarter, a half year, a year, that kind of thing. So review it in that context. But this will give you just a bit of a guideline. And right, so what's the outlook? I have a few comments here because you never really know. Remember, securities lending is a secondary market activity. The need to borrow securities is dependent on whatever's happening in the market conditions, just as I talked about here. These sorts of factors at a macro level, and then obviously at the micro level, individual company levels, those are the things that drive the need to borrow and therefore the opportunity to lend and the associated lending revenues. So we don't just really create securities lending transactions other than to refinance positions, but those are not new loans. And in fact, refinancing usually means that there's less revenue at the end of it rather than more revenue. Securities lending is reactive in that sense. So since I can't tell you where the stock market's going or how volatile it is, I can't really tell you what's going to happen with securities lending. In terms of the positives that I see right now, though, look, volatility is up, right? That's the truth. Here's the VIX in this chart. So you can see that it's trending upwards. And we've had some pretty big spikes over the last, generally speaking, these are not great points. These low points, they're not great times for securities lending. This plateau means that there's more activity happening in the market. And as there's more volatility, you will see some good returns. Hopefully, this is a harbinger of better returns. The other thing, of course, and I've talked about this, rising interest rates. So we see expectations of whatever it is, 3, 4. I've seen people talk about 7 interest rate rises in the US over the coming year or two. As interest rates rise, the opportunity to make money from reinvestment of cash collateral increases. That's a good revenue generator for borrowers and lenders, and is generally a very big positive for the business. And of course, the bottom line is also there's greater participation. There's more retail investors. There's more institutional investors going in. Hopefully, that also means that there are opportunities for new funds coming in that take different trading strategies. And it's that sort of constant dynamic between the supply, the availability, the breadth of it, the depth of and the stability of those positions versus the demand. If the supply increases, if more trades get automatically traded through things like Equilend and a lower post-trade processing cost environment, I think we'll see volume and activity go up generally over time, not at any given point, specific spot in a timeline, but overall. So look, those are all the positives. The negatives, the reality, there's 2 that I see that really stand out. One is the falling prices, which I've talked about. If you just have a lower market and have all the same outstanding loans on your books at the same fees, you'll just make less money. So that's tough. And there's not a lot you can do about that. Raising your fee levels sounds like it's a solution, but quite frankly, do you end up pricing yourself out of the loan itself? And is that really a positive? And then the other thing is this return to normal. So what do I mean by that? Number one, we see many central banks talking about the end of quantitative easing. They have stopped their asset purchase programs, so they have plans to stop that. That is going to have an impact on the market, without a doubt. The other thing is, of course, stimulus checks, which, in my personal opinion, contributed to the rise in the markets over the last couple of years. but also the extreme volatility and price rises that you saw with GameStop and many of the other meme stocks. Look, I'm all in favor of less central bank intervention, right? I 100% am looking forward to that, but there's no question that that has an impact on the market. And I think by and large, that is not necessarily a good thing for the securities lending business. There are positive sides to it, though. So it's not just completely one directional, but I think overall, the more normal we get into the market, the more we get back to a new normal, which looks, if it looks anything like the old normal, that's possibly a negative, with the exception of interest rates, right? If interest rates go up, and as a big mortgage holder, I think that kind of is not great. But as a corporate person, for securities lending, I have to tell you, it's a tremendous opportunity. So again, if you're not looking at cash collateral or you haven't done it before, now might be the time to start taking a look at that. So I've got a question here from Nilesh, who says he's from India, working at Nomura. Nomura is where I first started working as a borrower. I'd been a lender in many places, but I was a borrower when I joined the team at Nomura in '93, and I was there to '98. So it's always got a special place in my heart. He says your whole channel is very informative. Thank you very much for the compliment. And the topic of T+1 short covering, I might cover off with CSDR in next week's view, because I think that's really important. The question is, if we go from T+2 to T+1, what does that mean? If we go from T+1 to T0, what does that mean? But also, what's the impact of fail coverage? And many of these issues interlink. So interest rates being as low as they are, in my opinion, have contributed to a lack of settlement discipline, because it is cheap to fail trades, because if people claim from you, no one really cares. And the market that stands out as an exception to that is the US Treasury market, because there's automatic penalties built in that are expensive. And so guess what? Not a lot of fails. So Nilesh, if you just hang on with that question, it will be available probably next week. I think I'll be talking about it then. So revisit the show next week. If you think that's helpful, give us a thumbs up, and that will remind me to include that next week. Okay. Oh, look, the other thing I want to talk about, just this comment here about this greater participation and talking about the breadth of it. I pulled this article out from Global Capital, where the headline says UBS rewarded for sticking with prime brokerage. And you probably can't read the fine print below the UBS image. It says securities lending and other prime services seen as part of effort to woo wealth management clients. So that's the example, right? The number of brokers, the number of firms, the number of private banks that are either in the business or considering getting into the business or should consider getting into the business, that's just growing year on year. And securities lending is a critical part of that. There's not many opportunities for investors to generate only positive incremental income day after day, week after week, month after month, year after year. And securities lending is one of those things. So that's a good example. That's also a recent headline that came out in the past couple of days. So this is not old news. So let's just wrap this up. This looks like it's one of my shorter videos, so you get even more of your Saturday back if you're watching it live. So one of the good news slide, there we go. That's the good news. The good news is, to me, there's more activity in the market. There's more volatility in the market. Those are both positives. If you look at the bad news, though, falling prices clearly impact the revenues. Usually, I showed you that matrix. So you've got the top quartile, high rising prices, high volatility, the opposite end, flat or falling prices, but with very little volatility. And then the other two segments in between. Look, history repeat, who knows? That's just something to watch. My own personal outlook, if I try to figure out where we go, I see rising interest rates, I see falling market prices, and I see increased volatility. So for me, that's very much strongly in that sort of second segment where you have overall falling prices, but a lot of volatility. If that stays for a long period of time, you can still make a reasonable return this year. I think this will probably be not a year to write home about, but I think it should be overall a positive year. But look, it's February, whatever. It's February 5th. I have absolutely no idea what's going to happen in the market for the coming 11 months. If I did, the old saying, I wouldn't be here doing this video. In fact, I probably would, because I love doing this. But a sensible person would be probably on the beach, having made their bets for the year, knowing what the outcomes. A good year, not a great year, is what it's looking like right now. But we'll track this through. And of course, I'll do this with other videos. We'll follow it up maybe on a quarterly basis or as more data comes out. We saw the BlackRock and the State Street figures. They're not the only banks that report. There's an increasing number that do. We haven't seen the Schwab numbers, or I haven't seen the Schwab numbers. They're always interesting to look at as well. The only other comment I'd make about the revenue figures that you saw, there is a mix of reporting there. Sometimes firms talk about securities lending revenue. Sometimes they talk about securities finance revenue. And then you see the brokers often talk about sort of margin revenue. And so many of those things could be lending activity, borrowing activity, lending money activity, and leverage to customers. So there's a number of different components. So you can't really compare firm A to firm B unless they're using very similar terminology and you've looked through. But this is about trends, not relative performance of the firms. I'm not saying that any of these firms are particularly good or particularly bad or having a good year or bad year. It's just the numbers that they're producing, and we're trying to put it in the wider context. Hopefully it'll be a good year. Next week, as I said, we'll be talking about CSDR and securities lending, the latest regulation that'll be having an impact on the business. The SEC is still in their consideration phase now. And Nilesh will add your question into the T+1 short covering next week. So look, that's it from me. I hope you found this useful, interesting, and maybe a little bit entertaining or not. Thanks for joining me. Have a great Saturday. Have a great weekend. Have a great week. And I will look forward to seeing you next Saturday for Securities Lending Saturday Live. Over and out.